Let's see if this sounds familiar. You have some money sitting in a savings account and it's probably making next to nothing and you're not really sure what to do. Now you have several options. One option is you could go to a traditional bank like is behind me to stick your money in a savings money market account. Chances are they're not going to pay you anything. If they were paying you something, then you wouldn't be watching this video. So today what I want to share with you are what are 7 alternatives to do with your savings besides sticking it with a brick and mortar bank. And I'm also going to share with you a crazy story of where a client of mine was keeping his cash. You're not going to believe where he was keeping it and you're not going to believe how much it was. You're going to find out all about this in today's video. Check it. All right, so let's go ahead and dive into it. What options do you have other than the traditional brick and mortar bank? Well, the first option that you have, which is probably the easiest, is some sort of online savings, some sort of online bank. Now, probably 5 to 10 years ago, it would have been absurd that you would have trusted an online bank to put your money. I mean, people just couldn't even stand the thought. And I know there's still a lot of people that feel very uncomfortable with the fact of doing online banking. But the reality is, like, this is the present. Like, this isn't the future, this is the present. And if you're not with the times, then it's probably time to start catching up. Now, there are so many different online banks. Now, most of them are trustworthy and I wouldn't even think twice about it. I would definitely want to know how long the bank has been around. And the big kicker is, are they FDIC insured? If they don't have the FDIC insurance, then you don't even want to mess with it. Now, some of the banks that I'm more familiar with are Ally, CIT, Synchrony. There are so many more online banks today than there were a year ago, 3 years ago, especially 5 to 10 years ago. Just make sure that you do your research. Now, why would you want to choose an online bank versus a traditional brick and mortar? Now, a lot of the brick and mortar banks offer online banking through their apps, through their website. So why do you even want to mess with the online bank? Well, the reality is that because they don't have these brick and mortar locations, they don't have the overhead, they don't have the cost to keep the bank going. They don't have all the employees at a traditional brick and mortar. They don't have the real estate. They don't have all the expenses that go along with that. So they should be able to pay you a higher interest rate than you would get at a traditional bank. For example, I was curious to see, what does my bank pay on their savings account? You know, if I were to go open up a savings account or a passbook savings, and their savings accounts, their passbook savings rate starts at 0.05%. That is correct. 0.05%, not 5%, 0.05%. Now, they will pay you a higher rate as your account grows or as it gets to a higher balance, but unless you have $50,000 to $100,000, then what they're paying you is next to nothing. So let's compare this to an online bank. Now, I compared a ton of different online banks looking at what their savings account rates were, and I found anywhere from 0.65 as high as 0.85 is traditionally where you're seeing those rates. And I did see in some cases where they were paying more than 1%. Now, I understand that 1% is still not a lot of money, but in this certain interest rate environment, would you rather get paid 1% or 0.05? I mean, to me, I want to make as much money as I can, so pay me the higher rate. All right, option number 2 seems a bit old school, but it still makes a lot of sense for those that are interested. So what is option number 2? We're talking about US Treasuries, correct, T-bills. Now, for me, this might date me a little bit, but I remember as a kid, like, my parents or grandparents would buy me like those savings bonds, you know, buy them in $25, $50, $100 increments, and that would be like a birthday gift. That is an option, but you don't have to go and buy, you know, these old T-bills that you used to get. You can actually do this all online, and you can go to treasury.gov to buy these T-bills. Now, typically, they're going to pay comparable that what you're going to see what CD rates are paying, maybe a little bit higher. They're a little bit longer term than like a 1-year CD or a 2-year CD. Either way, it is still another option. They're going to pay you more than that 0.05% than the traditional bank is going to pay you. All right, option number 3. Now, stick with me for a minute. Option number 3 doesn't sound like something that you would use for your savings account, but if you have enough in your emergency fund, now this is an option you could consider, but yes, it does come with a little bit or a lot more risk. So what is option number 3? Option number 3 is buying individual stocks, but individual stocks that focus on dividend. Now, obviously, just because a stock pays a dividend doesn't mean that it won't drop in value. Like, that could happen. Then again, if the stock is paying a 3% dividend, 4% dividend, or if you're looking at some of these limited partnerships that are paying 7, 8, 9, 10, sometimes double digits in dividends, then obviously that's paying a lot more than the 0.05% or the 0.85% that you'd find in online savings accounts. That being said, this is a lot more risk, and this is something that I would not put short-term money in. This is money that I would be looking at least 1 year, preferably 2 to 3 years, where I know that I didn't need the money. I would not be looking at 3 months, 6 months, 90 days to put my money into a high-paying dividend stock and thinking that that is the right thing to do. But if you're fine with more risk, if you're fine with also the potential of not just getting the dividend, but also getting appreciation in the stock because you have a long-term perspective, then a high dividend paying stock could be a good option. So where are you going to do this at? Now, you can go to, funny enough, a traditional brokerage account or a traditional brick and mortar brokerage firm to do this, or you can go to online options. And I've talked about all these different options on other videos, so check those out. But you have E-Trade, Ally Financial, even Robinhood, which you can buy stocks through Robinhood as well. So you have so many different options to buy these stocks. So option number 4 is a little bit more traditional. We're talking about what is the opposite of stocks? Bonds. Now, when I started in the business as becoming a financial advisor, it was much more common for investors to buy individual bonds. So people would buy 10-year bonds, 20-year bonds, or if you were buying a municipal bond, sometimes the maturity would be up to 30 years. But back then, when interest rates were a lot higher, people didn't mind locking up their money for 20, 30 years if they were making 8, 9% on their money. Now, it's not as attractive, but still bonds can make sense. Now, most likely you're not going to buy individual bonds. So what are you going to buy? So you can buy bond mutual funds. Now, mutual funds have all their costs, and you have A shares, which you could get, you're gonna pay an upfront commission. You don't wanna do that. And if you're not sure about that, you can watch my other video where I talk about the 5 biggest ripoffs to avoid when it comes to investing. I talk all about A shares. So if you're not buying mutual funds, if you're not buying individual bonds, what are you buying? So what I would suggest is looking at ETFs. So you can buy different indexes, different bond indexes on whatever maturity that you're looking for, how much risk that you're comfortable with bonds. Because what people don't realize is that just because it's a bond doesn't mean that it's safer than a stock. A lot of times people think that, oh, stocks are aggressive, risky, bonds are safe. Not entirely true. For example, 2 different ETFs that you could buy that are 2 totally different types of bonds are a high yield bond ETF or a municipal bond ETF. So what's the difference? A high yield bond is one, it's paying a higher yield because there's more risk involved. So this is typically like a corporation or a company that maybe has a lot of debt. Maybe their cash flow isn't where it needs to be, so they're paying a higher interest rate. So you're gonna get more. As an investor standpoint, you're gonna get a higher interest rate because there's more risk with that company of that company going bankrupt and you losing your money on your bond. So yes, it's gonna pay you more, but there is risk involved. Compare that to a municipal bond and a municipal bond ETF. So a municipal bond is typically issued by some sort of state government, a city, a hospital. Sometimes it's for like roads, it could be for like new stadiums, anything to do with typically municipalities, you know, which towns, cities, states, all that good stuff. So with these, they traditionally are more safer, not as much risk, but because of that, you're not going to get as a high return. So these are all the different things you want to factor in, and you don't have to buy the individual bonds because now you can buy the ETFs. So I know what you're thinking, Jeff, these sound great. You know, the last 2 options sound fantastic. I just don't trust myself in picking the right stocks, the right bond ETF. So if I don't trust myself, then what other options do I have? And that is option number 5, which is a blended portfolio. So typically now we're looking at something like a 25% stock, 75% bond, maybe 20% stock, 80% bond, and we're utilizing ETFs to get us this portfolio blend. But Jeff, you just told me that I don't have to pick the ETF, so how am I going to build a blended portfolio when I have no idea what I'm doing? That doesn't really help me. So that's why we're going to utilize a platform like Betterment or Wealthfront. So with these two companies, these two investment firms, you just choose your investment goal. So you choose what are you trying to accomplish, and most importantly, what is your timeline? When do you need this money? And if you are choosing a timeline that is short, 3 years, 5 years, they're going to automatically place you into a blended portfolio that is far less in stocks, more in bonds, so that you are taking a lot of the risk off the table. You need to know this. Just because you have 20% stocks, 80% bonds, that doesn't mean that if we have a market correction that you're not going to lose money. You very well could lose money, you probably will lose money, but by having a blended portfolio and having less in the market, you should see a less drop that if you were in individual stocks, individual bonds. So that's why you choose that option. All right, before I get to the last two, I mentioned at the beginning of this video about a client of mine. Actually, not entirely true. This is a former client of mine, but one of the first meetings that we had, he let me know that he had a certain amount of cash that he was keeping in a quote safe place. And initially he didn't tell me how much he had, but then as we started talking more, started going through all his other investments, I come to find out, I learned this guy has over $140,000 in cash. I'm talking $140,000 in cash, like rolls and everything, in his safe in his basement. 140 G's in the safe, in his safe in his basement. And I don't remember exactly how long he had his cash sitting there. To me, it was just absurd. Now, thankfully, it was a fireproof safe. Nonetheless, he had $140,000 sitting in cash, making nothing. Should have just buried it in his backyard. But I don't know how much interest he lost on it. I didn't want to like calculate that. But that by far was one of the craziest things I've seen anybody do with cash. So this is not one of the options I'm going to talk about. So this is an option that you do not do. Don't keep it in the safe. Don't hide it away where you don't know where it is. Bad idea. All right, so let's get down to the last two alternatives when it comes to traditional bank accounts. So number 6 is real estate investment trusts, otherwise known as REITs. Now, I've talked about REITs and investing in real estate in other videos. Actually, there's a video that I talk about the 8 different ways that you can invest into real estate without actually buying or managing any properties. So that's a video you're gonna wanna check out. In that video, I talk about REITs. Now, REITs are packaged, sold, available in many different formats. So you can buy kind of like stocks. These are companies that they specialize in managing real estate properties. So you can buy stocks that do that. You can buy mutual funds that do that. You can also buy ETFs that buy and manage different properties, you know, whether they're buying individual REITs or they're tracking some sort of real estate index. So there are many different ways that you can do this. Now, you're probably going back to the stocks and bonds options I talked about earlier, where it just gets confusing because, okay, Jeff, if there are so many different options, then what do I do? So I think the most simplest way is buying some sort of REIT ETF. I think that's a very simple way. You're gonna get a decent dividend, you're gonna get access to real estate, so that's one way. Now, another way that I'm more partial to is online real estate crowdfunding, online real estate investing. So you have companies like Fundrise, Realty Shares, Rich Uncles. There are several out there and more are becoming available. Now, the one that I'm more partial to, and this could change over time, but the one that I like right now is Fundrise. So Fundrise, basically what they are is a real estate investment trust company. This is what they do. They go out and buy the properties, they manage the properties, you just invest the money and they take care of the rest. Now, what I like about Fundrise is that it doesn't take a lot to get started. You can open an account with Fundrise with $500. You know, a lot of mutual funds, you have to have a minimum of $1,000, $2,000, $2,500, some are even higher than that. So the fact that you can get access to real estate properties for as little as $500, and all you have to do is log on your laptop or your computer at home or even your smartphone. I mean, that's legit. All right, number 7, the last option is peer-to-peer lending, and I've talked about this before. So here there are options like Lending Club, Prosper. Now Lending Club is the one. Yes, you can go ahead and do a quick Google search and you can see that Lending Club has had some struggles with their executive team, with their CEO. That being said, I've had a Lending Club account now for several years. And I'm trying to remember exactly when I opened it. Just to be safe, I'm going to say 2011 is when I opened my first account. Currently I have, I think it's 4 different accounts with them right now. Opened up a newer one here recently with $5,000, and I did a video where I shared my previous Lending Club experience as well as me picking or building the portfolio, my new portfolio in Lending Club, so be sure to check out that video. But peer-to-peer lending is allowing you to be the bank. So instead of going to the traditional bank and putting money in their account and having them pay you a small bit of interest, you're doing the complete role reversal and you are becoming the bank. So now you are lending the money to other peers that are borrowing the money for different purposes. It could be consolidating debt, paying off credit cards, could be a business loan, could be a wedding. I mean, there are so many different reasons, obviously, that people are borrowing money. Now, the cool thing is that you can actually see what the reasonings are, like what are they borrowing the money for? And like the ETFs I mentioned before, whether it be stocks or bonds, you can be as aggressive or conservative as you want with that. So it really just depends on what your comfort level is. Now, I will say that a lot of the other options I've talked about, and I mentioned this earlier in the video, but it's worth saying again, is that these are not 90-day, 6-month, 1-year type investments. These are not options that if you need access to your money right now or tomorrow or next week, you're not going to want to do some of these investments, because with Fundrise, for example, there is a redemption fee, meaning that you're going to pay some sort of transaction charge to get your money back. With Lending Club, yes, you can sell your notes, but it's on the secondary market and you have to find a buyer, and it could take a few weeks to finally sell your notes to get your money back. So if you are needing quick access to your cash, you don't want to consider these options. But if you already have your emergency fund intact and you want to make more interest, that's where these 7 alternatives can make a whole heck of a lot of sense. All right, so that is the 7 alternatives to traditional bank accounts. I hope that I've given you something to consider. As you can see, there are so many different choices. You can do all of them, you can do one of them, you can do none of them. But all I want to share with you is that there is more than one way to invest. There is more than one way to earn interest on your cash. So which option sounds the most attractive for you? Let me know in the comments below. Which option are you going to take advantage of to earn more interest on your money? Like I said, let me know in the comments below. Appreciate you checking out this video. As always, this is Jeff Rose reminding you that it's your money, it's your life, and only you can make it awesome. Take care. Show me the money. Show me the money. Gotta get me that money. Gotta get me that money. Money, money, money. Money, money, money. Money, money, money. Money, money, money. Hey, hey, hey.